Hello and welcome to episode 15 of the Alex.nunemaker Mortgage Podcast for the week of September 19th, 2022. In market news, it's Fed Week. Wednesday is the big day, around 2:30. Federal Reserve is going to be finishing their meeting. They're going to be releasing their notes, and the market is going to be looking very closely at their comments. We're hoping that this bodes well for Mortgage Backed Securities, which have taken an absolute beating over the last month. If you listen to my podcast in past weeks, you know that my advice has been date the rate, marry the house, meaning that the interest rate and the loan that people are using to buy the properties today very likely will not be their mortgage loan over the course of the next year or two, where they're going to have the ability to refinance. And there's actually a lot of evidence that points to this. This is something that I'm going to cover in this week's Mortgage Corner. This is something that we as mortgage lenders see right on our rate sheets. So in the Mortgage Corner, I'm going to give you an inside, behind-the-scenes look at an interesting phenomenon that's happening in the mortgage industry lately, and that is the disappearing lender credit or premium pricing. Now, what do I mean by that? So on any given day, as you know, mortgage lenders, we have a lot of different interest rates that we can quote. So let's rewind the tape back to 2021. Let's say on one day in 2021, I was able to give an interest rate of 2.75% with no points. That same client could get a lower rate by paying points to buy down the rate, say 2.25. It also works on the opposite end of that spectrum. So if I had a client who needed some help covering closing costs, I could give them a higher rate, let's say 3.5%, and give them a 3% credit towards their closing costs. Now, why am I, as a mortgage lender, able to give that 3% credit to that client? Remember, the prevailing interest rate was 2.75%. So if I'm a mortgage-backed securities investor at a coupon rate of 3.5%, I am more than happy to buy that mortgage loan at a premium. Let's say a $300,000 loan, I would pay $309,000 if the interest rate is 3.5%. Why? Well, because I'm getting a higher interest rate, I'm able to collect more interest over time. So the big assumption is that loan, I'm going to be able to collect that interest rate over the course of time and make back that extra $9,000. Now, fast forward to today, what we're seeing in the mortgage industry, in the secondary market, in the bond market, and on our rate sheets, is that investors are extremely hesitant to offer rates that give a premium. Why is that? This tells us that there's very little demand from the secondary market or mortgage-backed investors for rates at a higher interest rate. They don't want to buy that loan at a premium. Why wouldn't they want to buy that loan at a premium? In times where rates go down, loans get paid off in the form of refinances. So again, the assumption where someone is going to buy a loan at a premium, they're saying, I will buy this loan at a higher price because the higher interest rate over time will give me the return on investment. It doesn't work if that loan gets paid off in a refinance. So what this tells us is that the secondary market, mortgage-backed securities, the bond market is saying, we see the ingredients in the future where refinances are going to become prevalent, which means that rates are going to go down. We don't know when, but they're saying we're not going to buy loans at a premium because what's the point? This loan is going to get paid off in 6 to 12 months anyway. So this is real-time evidence that mortgage lenders are seeing right there on our rate sheets that the bond market is telling us that rates are going to go down in the future. So how does this impact your clients? So in the short term, the big loser, unfortunately, are those cash-strapped clients where there would normally be options to give these big lender credits, 2 or 3%. That option goes away, at least here in the short term. But what it also tells us is for anybody who is nervous about interest rates, this is just one more piece of evidence that tells us that rates are going to go down in the future. Rates are painful right now, yes, but the big money is betting and forecasting that lower rates are going to be in the future and they're going to be able to refinance into a lower rate. We just have to get through this uncomfortable time right now. And finally, our quote of the week. To be successful, you must be comfortable being uncomfortable. Have a great week. And if you have any questions or if you have any clients that I can help with pre-approvals, let me know. They can visit me at homeloanswithalex.com. Have a great week.